Welcome to the deep dive. Today we're going to unearth some real dividend gems for you, especially since you're looking for yields that'll crush that puny 1.2% S&P 500 average.
That's right. Yields that'll put a smile on your portfolio's face.
Exactly. And our intel today is focused on three companies: Enbridge, TD Bank, and Hormel Foods. Each one's got a unique story, and by the end, you'll know if any of them deserve a spot in your portfolio, ready to start digging.
Absolutely. Let's crack these companies open and see what makes them tick.
All right, first up, Enbridge. They're a big player in energy, specifically the world of midstream oil and gas transportation pipelines stretching across the country.
Pipelines might not sound too exciting, but Enbridge has turned them into a dividend machine. 29 years of dividend increases in a row. That's amazing.
Yeah.
It all comes down to their fee-based business model.
Fee-based. So tell me more, because a 29-year streak definitely has my attention.
Well, it's pretty straightforward. Enbridge makes money by charging fees to transport oil and gas through their pipelines. Doesn't matter much if oil prices go up or down, they still get paid for moving it. This steady income lets them pay and even increase those dividends year after year.
That explains the 6.4% dividend yield, way above average for energy companies. But here's a twist. Enbridge isn't just doing pipelines, they're also getting into natural gas utilities and even some clean energy projects.
It is fascinating to see a traditionally dirty energy company like Enbridge making this shift. What do you think? These new ventures now make up about a quarter of their earnings. It's like they're hedging their bets on the future of energy.
Makes them less of a pure play in energy, though, which some investors might not like. But for others, it could be a sign that Enbridge is adapting and positioning themselves for the long haul.
Exactly. The question is, does this diversification make Enbridge more appealing, or are you more comfortable with a company that just focuses on one thing?
It's a great question and something to think about. But let's move on to our next contender, TD Bank.
It's a pillar of finance. TD Bank's a top 10 bank in North America. They've been paying dividends for over a century.
Over a century. Wow. Talk about commitment to shareholders. And that commitment shows in their dividend yield, almost 5.3%, more than double the average for banks.
There's a reason for that high yield, though.
Oh, yeah. You're talking about that money laundering scandal, right? The one where they got hit with that $3 billion fine.
Yeah, it's a serious issue for sure. And U.S. regulators also put an asset cap on them, limiting how much they can grow in the U.S. market.
Not a walk in the park for TD Bank. But even with that fine, they can still pay it without too much trouble.
That's the thing. TD Bank is a giant, and this fine, while big, isn't going to crush them.
Makes you wonder, though, if the U.S. is restricted for them now, where will their future growth come from?
Now, that's the real question. They'll need to find new ways to grow, maybe by expanding to other markets or focusing on different products and services.
Classic example of how even successful companies can face these unexpected challenges. So does this make TD Bank a good opportunity to buy low, or is the risk just too high?
All depends on your risk tolerance. Are you okay with some uncertainty if the potential reward is big enough?
Definitely something to think about. Now, ready for our final company in this part of the deep dive?
Hit me with it.
Okay. It's Hormel Foods, the company behind the one and only. Wait for it. Spam.
Uh-huh. Spam might be what they're known for, but Hormel is way more than just canned meat. They have tons of protein-based food products in grocery stores and restaurants all over.
True food industry giants. And their dividend history is unbelievable.
Wow.
58 years of dividend increases every single year. That's what makes them a dividend king.
Not many companies can say that.
And their dividend yield right now is a juicy 3.5%, almost an all-time high for Hormel. So if they're doing so well, why is the yield so high? It's kind of weird, right?
Let's just say even kings face their own battles.
Tell me more.
A whole bunch of problems that hit Hormel at once. Rising costs are hurting their profits. The recovery in China has been slower than expected, and they've even been affected by the bird flu, which messes with poultry prices.
And their Planters peanut business. That whole snack nut thing has been a struggle for them.
All good points. The real question is, are these problems just temporary, or are they bigger signs of trouble for Hormel?
It's like a detective novel trying to figure out if Hormel can keep their dividend streak alive.
That's a great way to put it. Investing is all about understanding the story behind the numbers.
So there you have it. 3 companies with different stories and compelling dividend yields. Stay tuned for the next part of our deep dive, where we'll analyze these companies even more and talk about what it all means for your investment strategy.
Welcome back. It's really interesting how these companies, pipelines, banks, food, can have such complicated stories behind them.
It's true. We've only just started. Before we get back to those companies, I think we should zoom out and look at the bigger picture. We got these 3 companies, all with great dividend yields, but each one's got its own problems. What does this tell us about the market, especially for people like you who are looking for income from their investments?
That's a good point. It shows that things are kind of strange right now. The S&P 500 is at all-time highs, but dividend yields are still low. It makes it hard to find those steady income-producing stocks.
Right. So should investors just accept those low yields and move on? Or is there a way to find those hidden gems companies that give you both income and growth?
I think it's all about looking beyond the obvious. Those big famous companies everyone loves. Sometimes the best opportunities are the ones that are kind of unpopular.
Yeah.
Facing some problems. Or maybe people just aren't paying attention to them.
So are you saying that companies like Enbridge, TD Bank, and Hormel Foods with their problems and high yields could actually be good buys?
It's definitely possible.
Yeah.
But you got to understand why the yield is so high. Is it because the company is really undervalued and has a bright future? Or is it because there are serious problems and investors want more money for the risk they're taking?
So that's where research comes in, right?
Exactly. Look at those financial statements, check out the management team, see who their competitors are, and try to understand their long-term plan.
It's like being a financial detective, putting all the clues together to see if the company is really worth investing in.
I like that. And don't be afraid to look beyond the usual places for information. Talk to other investors, read industry reports, go to conferences, maybe even visit the company yourself.
Speaking of digging deeper, let's get back to those three companies and see what else we can find.
Sure. Where do you want to start?
Let's go back to Enbridge. We talked about their great dividends and their move into clean energy. But what are the risks with that strategy?
Well, one risk is that they try to do too much. Trying to be good at everything can sometimes make you not good at anything.
Right. If they're investing in pipelines, natural gas, A&D, clean energy, are they really good at any of them?
Exactly. And there's also the risk that their pipeline business might decline faster than they expect as the world switches to cleaner energy.
So even though they're investing in clean energy, it might not be enough to make up for the loss in their old business. It's a tricky balance.
It is. And investors need to think about it carefully. Is Enbridge doing the right things to prepare for the future? Or are they just trying to look good for investors and avoid becoming obsolete?
I guess only time will tell, but it's definitely something to consider.
For sure. Now, how about TD Bank? We talked about the money laundering and the asset cap. What about their growth strategy? What's next for them?
It seems like they're in a tough spot. Limited growth in the U.S., which is a huge market for them. So what can they do?
Well, one option is to focus on Canada. The Canadian economy is pretty stable, and TD Bank is already a big player there.
Focus on what they know. Makes sense.
Another option is to go to new international markets, maybe Latin America or Asia, where there's lots of potential for banking growth.
That's a risky move, though, right?
Of course. Going into new markets takes a lot of money, and it's always uncertain. You have different rules and cultures to deal with.
It just goes to show that growth is hard, even for a big company like TD Bank.
Totally. They'll need to be smart and make tough choices about where to spend their money.
So for investors, it's all about whether they believe TD Bank can overcome these challenges and find new ways to grow.
Yeah, it's a bet on their ability to adapt.
All right, let's finish this part by talking about Hormel Foods again. We talked about them being a dividend king and all the problems they're facing. But can they come up with new ideas and adapt to how people are eating these days?
That's a great point. The food industry is always changing. People's tastes are different, new trends pop up all the time, and there's a ton of competition.
So how's Hormel dealing with all that? Are they just waiting and hoping for the best? Or are they trying to stay ahead of everyone else?
Well, they've been trying to add more variety to their products. They bought brands like Skippy Peanut Butter and Justin's Nut Butters, trying to get into the healthy snack market.
Interesting. They're not just sticking with their meat products anymore. They're trying new things.
Yep. And they're also spending money on research to make new products that people want, like plant-based protein and easy meals.
It sounds like they're not just sitting around. They're trying to innovate and stay relevant.
Yeah. But are they doing enough? Can they keep up with the changing food world and keep that amazing dividend streak going?
That's what investors need to figure out. Are they betting on Hormel's history and ability to overcome problems, or are they worried that the company might be falling behind?
It's a tough choice for investors. Do you stick with what you know or try something new?
Lots to think about. I think we've covered a lot in this part. We talked about the overall market, the good and bad for these three companies, and why research is so important. Ready to wrap things up and give our listeners something to think about?
Let's do it.
Great. Stay tuned for the last part of our deep dive, where we'll do just that. Welcome back to the final part of our deep dive. We've journeyed through energy, navigated the world of banking, and explored the always-changing food industry, all in search of those dividend gems.
And we found some really interesting things along the way, haven't we? We saw how even stable companies can face big challenges and how those challenges can be opportunities for investors.
That's so true. We talked about Enbridge's move to clean energy, TD Bank's struggle to grow with all those regulations, and Hormel Foods trying to adapt to what people want to eat these days. But what does it all mean for you, our listener, who's looking for dividend stocks in this crazy market?
That's the question, isn't it? And I think the big takeaway is don't be afraid to think outside the box. Don't just chase the highest yield or do what everyone else is doing.
So you're saying be a smart investor, not just a yield chaser.
Exactly. Take your time to really understand the companies you're looking at. Go beyond the headlines and look at the details. Are those high yields a good sign, or are they hiding bigger problems?
It's like being a financial detective, like we talked about.
Yep. And remember, investing is a marathon, not a sprint.
Yeah.
Don't get discouraged if you don't find the perfect investment right away. Be patient. Do your research and focus on your long-term goals.
It's about building a portfolio that fits you and your goals, one that can handle the ups and downs and keeps growing over time.
Well said. And don't be afraid to get some help. There's tons of information online, like financial websites and investor forums, and talking to a financial advisor can be really helpful, especially if you're new to investing or feeling lost.
It's like having a guide in the confusing world of investing, someone to talk to and help you stay on track.
Right. And there's no one right way to invest. What works for one person might not work for another. You need to find a strategy that you like and that works for you.
It's about taking charge of your money and making good decisions. So as we wrap up this deep dive, let's leave you with one last question to think about.
Okay, I'm ready.
If the S&P 500 keeps going up and those normal dividend stocks stay stuck with low yields, could these companies with their problems and high yields actually be a good opportunity for smart investors who want both income and growth?
That's a really good question. It makes us think about where to find value in the market and not be afraid to try something different.
Exactly. And that's what the deep dive is all about, helping you think critically, explore new ideas, and never stop learning. Until next time, happy investing.